when we're on. And we are live.
We're live, right?
There you go. So how you doing there, Vitaliy Katsenelson? Thanks for being my special guest today, Vitaliy.
Oh, it's my pleasure there, Darcy. Thank you.
Awesome. Now you're sitting all the way over there in the mighty United States of America in Denver, Colorado. Is that right?
That's right.
Yeah. Fantastic. And so I think you're my first guest that I've actually had overseas. So appreciate the time differences and the fact that you probably just had a busy day. Thanks for coming on.
That's, I'm a quarantine like everybody else. So Tuesday or Sunday all kind of blur together.
Yeah.
So.
Yeah. Fantastic. And in New Zealand here, we're just coming out of 4 to 5 weeks of a lockdown period, an imposed lockdown where we've had to kind of shut down the entire economy, shut down our lives, and basically just stay indoors. What's it been like over there in the United States and your neck of the woods there in Colorado?
It's same thing. We've been here for probably 5 weeks. And, when you are in the investment profession, my life has probably been disrupted the least, right? Because our business, still going. I'm just working from home and spending more time with my kids.
Yeah,
and that's about it. So it's really, my life hasn't really changed that much. So
yeah, that's right. And so just for our listeners, Vitaliy, or our viewers, tell us a little bit about what you do and a little bit about your background, because like me, you've got a bit of an accent, so I'm keen to know more.
That's right. Oh, well, so I was born in Russia, and in the Soviet Russia. So I moved to the United States in 1991 when I was 18 years old. When I was 21, 22 years old, I stumbled into investing, and I realized how much, that this is. I was in college, and I think I was changing majors every 2 weeks or something, and I realized I love investing, and I basically for the last 20-something years, I've been basically investing in the stock market. And I got my undergraduate degree in finance and graduate degree in finance from University of Colorado. I'm a chartered financial analyst. And I actually been taught investing for 7 years at the University of Colorado. So, yeah.
Okay. And tell me a little bit what it was like growing up in Soviet Russia, because we kind of sampled a little bit about what it would kind of like an experimental, idealistic version of socialism just coming out of this lockdown period here in New Zealand. Tell me what it's like in full-blown, fully submersive socialism in Soviet Russia.
Yeah, well, so far you experienced the fun part of the socialism because you experienced the part where you didn't have to work; you just get paid for it. Well, the part is like there's a payback time as well. So at some point you have to pay for it because what you basically did, you borrowed from your future because the government had to borrow money to do this. So the biggest downfall of socialism is that at the core of socialism, that there was a belief that people will be motivated to benefit the society. So you wake up every morning and you're gonna try to you're gonna make decisions to make everybody around you better. Well, it doesn't really work. As humans, we are basically selfish, and not in a bad way. We just you're probably more concerned about prosperity of your family than prosperity of your neighbor or another neighbor next door. And that's absolutely right. And there's nothing wrong with that. And therefore, this is why capitalism works so well, because our selfishness, every day when we make selfish decisions, as together, when you add them up, they benefit the whole society. Okay.
Sure.
And in socialism, it kind of was a utopical, in my mind, system, because it would basically assume that you're going to make decisions that you're going to wake up in the morning and make decisions that will benefit the whole society, and that will motivate you. Well, that's not how the life works. So and then also the government was at the center of capital allocation, and some bureaucrat in Moscow would decide how much to charge me for sugar in 2,000 miles away. So that did not work either. So
right. Yeah. So effectively, capitalism is more closely aligned to the selfish nature that we all have. Yeah. So it's not a system that's in contradiction to who we are designed to be, which is unfortunately to look after number one, ourselves.
Yeah. So it's what it did. Socialism made me appreciate capitalism more.
Interesting. Okay.
Yeah. So when today you have millennials who kind of who embrace who kind of love socialism, they you can it's so easy to love socialism when you live in a capitalistic society and your parents pay for college. Once once you lived in socialism, you kind of start appreciating the nuances of capitalism so much more. And so I'll give an example. Right now, we are suffering through this enormous epidemic, and the reason I'm optimistic in the long term about this epidemic, that that it's gonna be solved, that we're gonna have a vaccine, we're gonna have cure, etc., because of capitalism, because you're gonna have this because this drive we have, innate drive we have to basically to survive. Okay. And anyway, so that's my 5 cents on this, on the virtue of socialism and capitalism, I guess.
Yeah, good on you. Good background. So in terms of I want to answer this question, what is value investing? And this comes from a place of just trying to understand. Often with investing, there are certain schools of thought, or there are certain sort of tribes that often we would like to belong to, so that we can find our place and look through the world with a lens that we can kind of make sense with. And so, I've often wrestled with the whole idea of passive versus active investing, even looking at the different asset classes. When is something considered alternative, and what does that really mean to be alternative versus mainstream? When it comes to, say, growth investing and value investing as a style, can you just help me clarify what that actually means?
Yeah, so it's kind of interesting. I would argue that I'll give you different answers. Okay.
Sure. Yeah.
The one answer is value investing is really just a philosophy. Okay. It's basically I kind of identify it's what I call 6 commandments of value investing. And I'll give you a few. So when you're a value investor, you invest, your time horizon is a long-term time horizon. You're not investing for the next 3 months. You're investing for years and years. When you analyze companies, you look at them not just pieces of paper, but as businesses. So just because this company is publicly traded does not make your analysis would not be much different if you were analyzing to buy a private company in Auckland, like you were analyzing, there was a gas station that's for sale near you, and you're trying to figure out how much to pay for it. My analysis of if I'm buying a company that owns thousands of these gas stations is not going to be, that's public, is not going to be much different than you analyzing that gas station that you're going to buy and you can't flip it 2 days later. Okay.
Sure. So you are actually a business owner. You put yourself in the mindset of a business owner, someone buying a pre-existing business, rather than someone who's playing a game, looking at the stocks and actually looking at the key performance indicators there. Okay.
That's right. So that's right. And then your true risk is not really the volatility, kind of how investors wake up and feel about your stock. The price stock, the price of the stock, but the true risk is actually the stock price, the price declining, not coming back. The permanent loss of capital. So those probably, so there's the another one would be another risk would be the permanent loss of capital. Right. I already mentioned it. Another one would be the stock market. Is there stock market? You wake up every day and the market says your company is worth this much, and the company is worth this much, and your job is not to take them too seriously, to Mr. Market very seriously, but actually do your research, figure out what that other company is worth, and see. And when the market misprices this company, you celebrate and say, "Great, I'm gonna buy it." Or misprices your company, the company you already owns, you say, "So what? I'll buy more with it. If I have the money to do this." So you look. So Mr. Market is there to serve you, not the other way around. So I call it the 6 commandments, and I'm gonna be a little bit promotional, but I'm not really.
Please do. Yeah.
I'm working on my next book, and the chapter from this book, the very first chapter, called "The 6 Commandments of Value Investing." People, your listeners and viewers can download it on the Contrarian Edge. It's absolutely free. They can go and download it. This is so I discuss those concepts there in much greater detail. That's all.
Right. So contrarianedge.com. is where they can go and they can find their
Yeah, they
first
can
check.
download the whole chapter, and
Yeah.
they'll
Okay.
get the 101 of value investing right there.
Okay. And but effectively what you kind of said before is that you do your research up front, you are putting aside all the noise, and you just shut up and you buy cheap stocks, basically is what I'm hearing.
Yeah,
You do your
well,
evaluation
yeah,
right.
no, so like at my firm, we're trying to find high quality companies. We want to buy them cheap. That's kind of, it's the marriage of these two things. So that's
Right.
right. Yes.
Right. So you're buying something, it might be on sale for $1. You're trying to get it for 80 cents or less, ideally.
Yes.
You do that hard work up front, and then you don't really worry too much about market sentiment, the volatility, because
No.
you've already done your work. And if the market on the day disagrees with you, you'll just jump on that and buy more of it.
That's right. And it doesn't mean that I'm indifferent what happens to the company's business after I buy it. Okay, that's it.
Sure.
We continue to analyze the company, and sometimes things change. Sometimes things that we did not anticipate
Yes.
to happen, or some, and so we have to. You continue to do your homework as you own
Yes.
it, right? Like you bought the gas station, and then to realize that when you were analyzing, you maybe did not think about the fact that maybe cars will go electric.
Right.
Well, that's a risk that you didn't think about before. Now you have to think, well, maybe that's not such a good investment.
Right.
And then, so so we continuously evaluate the risks. Yes.
Right. And so I guess the mindset that one needs to have when evaluating, a company and whether or not to buy shares in this company versus that company versus all the other ones is that as much as you understand business, that's kind of the headspace that you need to be in as a business person rather than a quote unquote investor. You actually have to be a business person and actually understand, appreciate what that business world is like, and actually engage on that level. And it's really subtle, but I can kind of get it. Like that's the mindset that you need to be in from the get-go. Not everyone understands business. And so that's the problem, right?
Yeah. So let me give you this analogy. So the problem is the stock market, that you can buy and sell stocks 500 times a day, and the transaction costs are almost zero or zero in many cases.
Yeah.
Okay. So what happens? Just because you bought Microsoft, it does not make you an investor. Okay.
Right.
Okay. Just because if you buy and sell Microsoft all the time, it actually you're a trader, or basically you can say it's kind of a glorified gambler. Okay.
Mm-hmm.
So just because it's not a blackjack, but it's called it's Microsoft. There's no difference if you just keep if you are treating stock market as a casino, and therefore, and in investing, you're right. Your attitude has to be like a business person, analyzing as a business, a company that you're buying a fractional ownership of a company as a business.
Right.
Yeah.
Gotcha. So it's kind of like, it just because you happen to be self-employed, an independent earner, it doesn't make you an entrepreneur or a business person.
No.
Just because you own a share doesn't make you an investor. You actually, you have to be a business person as well, or a part owner of that business. It's kind of the same concept, isn't it?
That's right. Yeah. So
yeah. Okay, fantastic. And so, like, to contrast that, or to mix it up a little bit, can you just help me understand what the difference is then between, say, growth investing? What a different mindset would be if you were a growth investor?
So this is where it gets very tricky, because usually when you talk about growth investing and value investing, they're kind of supposed to be different, like very different styles. They don't need to be. Okay, so think about the value investment as a philosophy. If you approach this value investment as a philosophy, then you can have companies that you're buying $1 for 50 cents. Okay.
Yes.
Okay.
Yeah.
You can also, as a value investor, that buys a company which value is growing at as well, right? And a growth investment. So let me try to say differently. There is a value in growth. Okay, when you bought Microsoft in 1990s, right? The reason Microsoft stock went up a lot, not because because its earnings have gone up a lot as well. If you can find a company and you feel very comfortable that this company is going to be worth, its business will grow dramatically over time, and you think you're buying it below what the business will be worth, you're basically practicing value investing. Because one of the things we haven't talked about, but as a value investor, when you buy something, you need margin of safety. Okay,
Right.
so like what you mentioned, you buy a dollar for less.
Yeah.
So that less is the margin of safety. So if you're buying $1.50, you got a 50% margin of safety. So usually it's confused that value investors are trying to buy these stodgy, not growing companies,
Right.
the kind of the IBMs of the world kind of thing.
Right.
It doesn't have to be this way at all. If in fact some companies, and I just wrote an article which is going to come out in a day or two.
Okay.
What one of our investments, which is Uber.
Yeah.
Okay, Uber is anything but a kind of traditional value investment.
No, that's right. Yeah.
But after we bought the stock, I got half a dozen emails from my clients asking me if their money manager was kidnapped, and somebody else. In that article, I kind of go through this.
Yeah.
So it's a 13-page article that can your listeners can listen on and invest with that family.
Right.
It's actually just came out yesterday or today. Anyway,
right.
So my point is, when we were buying Uber, the value in Uber is actually that we figured out that in the worst case we won't lose money, and there is a lot of optionality because 5 years from now the company's earnings will be so much greater.
Sure.
That therefore, based on those earnings, we were buying an undervalued company.
Right. So you kind of merge those two principles or philosophies of value and growth into one move. And Uber just doesn't sound like a value move to me at all. Not at all.
Yeah, absolutely. And I'd say that's exactly right. And I own Uber, and then I own a lot of stocks that trade at 8 times earnings too. So when I buy those stocks at 8 times that trade at 8 times earnings, I'm buying 50-cent dollars. And with Uber, I think I may be buying it in 40 or 30-cent dollars. It happened. Those dollars happen to be not apparent staring you in your face today, but in the future.
Okay, no, that's cool. That's a good example. So let's talk a little bit about So your role is like the day job. Let's say, I can tell where your passion lies. Your passion probably lies in educating and writing. I know that you also appreciate music as well.
That's right.
But what about the day job, being a money manager, right? Is that what you would call yourself?
I'm a money manager.
So, and I appreciate it a little bit different here in New Zealand in terms of the terminology and what we kind of what would be analogous to your profession here in New Zealand. But for all intents and purposes, people trust you with a certain portion or all of their portfolio, and then you would go out and you would invest it on their behalf. Is that right?
That's right. Yes.
Cool. So the kind of decisions that you make, are they kind of predetermined in terms of a formulaic approach on how you do it, or your philosophy is written down, kind of like a creed on how you invest? Is that kind of how you work? You fit within a model?
So the 6 commandments of value investing, that's actually like what I literally do. I just kind of say, here's what value investing is. Here's how we apply it. So that's that the chapter I was talking about. That's exactly what we're doing. So we are incredibly process driven. So like I look at what we do is kind of analytical factory. We just try to apply. It's like I can probably divide what we do into several steps. We identify, we look for companies to analyze. We analyze them. If it's a high quality company, then we start valuing the business. After we value the business, if we figure out that this is high quality business that is significantly undervalued,
yes,
we buy it, and then we watch it. And then when it gets to our fair value, we sell it. If something happens in between and we change our mind, we sell it, somewhere in between. And then we just kind of keep doing it over and over again. Yes.
Okay. So it's fairly straightforward. You're trying to find, you're trying to call the market out, aren't you? You're trying to say, right, the market or the share market is valuing it at X amount, or that's what the price is, but we believe the value is below this. And therefore the game is to buy it when it's discounted in a sense on the market, and sell it when it's at fair value, and then rinse, repeat.
Yes, that's right.
Got it. And that's okay. And so was that a high volume type of thing that you're doing? Because I'm picking up that there is a little bit of transactions that will happen within a typical portfolio. It's not like you buy and you hold and you just stay the course forever. There is a point where you would let go of some stocks, right?
Yeah, no. So I think we probably hold stocks on average 3 to 5 years.
Yeah.
So,
Okay.
so there is I love everything at a certain
Yeah.
price. So
Got it.
so
Yeah.
if I buy something, it goes up a lot, and it happens. But say I buy, it never happened to me before. But say I buy something,
Yeah.
and in one day it goes up to fair value, then I will sell it. Never happened. Usually it takes years for this to happen. But
Got it. Okay. So talk to me a little bit more about the whole Uber move, and maybe let's contrast that with, say, Tesla, which I'm aware that that's something that you haven't bought in the past. Is that right?
no, that's right. I own the car, and I
Yeah.
absolutely
So I guess
think
you have bought Tesla.
yeah, I bought Tesla. I own Model 3, and I think this is the most like whenever you buy a car. Like, I'm not a car guy at all. I'm like, the car is usually kind of very functional thing for me. It just gets me from a place A to place B.
Yes.
So I am the last person you would say that would be excited about a car. So after I bought, I owned my Model 3 for maybe 8 months.
Yes.
And I'm still as excited about that car now, 8 months later, as I was on the very first day I got it, which is usually doesn't happen, right? Usually you buy something and then it's just kind of, your excitement declines. Here, the excitement was fairly flat. It's actually, every time I drive it, I enjoy the hell out of it. So,
Yeah.
so, so Uber, so anyway, about Tesla. So when I bought the, after I bought the car, I realized this is like one thing I realized, this is the future. In other words, in my mind, it became very clear that at some point in time, I don't know, 10 years from now, or I'm not sure what the time frame exactly is, but electric is going to be the future. Like internal combustion engine cars are the horses, and we are transitioning to cars. Well,
Correct.
so it's kind of that's the analogy, right? So it's
Like a steam train. Yeah.
Steam train, yes. So it's kind of the same thing. I just don't know when it's gonna happen. I know the tsunami is coming. It's just hard to say exactly how it's gonna, when it's gonna happen.
Yes.
And so I ended up. It's kind of interesting. I spent a month. I've done an enormous amount of research, and I wrote a 35-page paper or 37-page paper on Tesla, which has 11 parts, and it's instead of me recycling, talking about Tesla, you're reading, your viewers can read the article, and they can, So I keep sending your viewers to my website because if I already spent 37, there are 37 pages for them to read, they might as well.
Get it? Yeah.
Uber is a quite different story. So with Uber, it's quite a different story because my analogy with Uber is. Let me give you this. Let me give you this analogy. Let's say you and I talking in 1998, and this whole internet thing comes out, and it's Wild West. There are thousands of companies, and you have no idea at the time what industry is exactly gonna win. Like, who's gonna be winners or losers. It's very hard to say. What's gonna happen, right? Then let's say we pass forward to 2003, 2005. And at that point, the digital advertising is going to be a significant industry. But because that people are spending so much time online, and just because we spend this much online, the advertisers go where the eyeballs are, right? Okay, so but at the time there's a MySpace, there's Google, there's Bing, there's Yahoo. There's so many players, so you don't even know which company to bet on, right? Now you know what to bet on, like kind of the industry. Okay, now fast forward to 2008. At that point, kind of 2010. Let's make it easy. 2010. At that point, you basically know that now the MySpace went out of business, and you really have one or two companies left that will dominate that space for a long time. which at the time would have been Google, basically. Like, there's probably, you can say about Facebook maybe, but you know that Google will be a significant player in this space, right? So now you know what and who. Like, we just, digital advertising, so at that point, you can, like, you and I talk about growth investing. Well, at that point, you can basically say, well, we know that the market is, the analog market is huge, and digital market share is still very small. At some point, digital market will be much greater, and Google is very likely gonna have a very large market share. Okay,
Right.
because at that point they already have a significant competitive advantage. They already can, so that's so this is kind of my analogy with Uber. Today people look at Uber and they remember the headlines from 2019, how Uber lost, I don't know, $5 billion, $5 billion, how the company doesn't make any money, and all the different stories. And all of that is true, except that is looking in the rearview mirror. Okay. And so let's talk about the future a little bit. So one thing I would argue that ride sharing, once we get through this coronavirus thing and things come back to semi-normal, ride sharing is most likely going to be a larger part. More and more dollars will be spent on ride sharing.
Sure.
And Uber seems to be the company that has won this battle in local markets. They're in 62 countries, and in every single one of them, they're number one or number two. Actually, I think in almost every market where they are, they're number one.
Sure.
Like I'm talking about ride sharing. And Uber Eats, which is kind of food delivery, they're either number one or number two.
Right.
And in the markets where they don't dominate, they left those markets already. So,
Sure.
What's important to understand, and if you looked at Uber, I looked at Uber for a long time as a customer. I love the service, but I couldn't. When I look at the company, they always lost money, and I couldn't understand why. And when I realized that this is a business, this is a digital business and analog business at the same time. So when you go, like, let's say, when Facebook goes from United States to New Zealand, right? It's the only thing it has to do. It just has to change the terms of service contract to comply to New Zealand law. It's done, right? So the cost of going to New Zealand is very small.
Right. I get it. Got it.
So when Uber goes to New Zealand, is that in New Zealand, by the way?
Yeah, that's correct. Yep, that's right.
Perfect.
Yeah.
So now it has to go out and it has to recruit the drivers. Okay, but think about it for a second. It recruits the drivers, because this is this is a two-sided market. If it starts advertising and saying, "Come and ride our Uber," but it has no drivers, right?
Yeah.
Then people will go to the app, click on it, and there are no cars, right? So what it has to do, it actually has to initially. In fact, I talked to a friend who brought Uber to Australia. They literally came to Australia, and they paid drivers to sit and do nothing.
Is that right?
Right.
Wow. Just the network was working. Yeah.
Yeah. So because they needed to have, so when you open an app, they needed to see, have somebody near you.
Yeah. Right.
Okay. Just think about it. That's a very expensive proposition. This is like socialism that you and I talked about, right? For a while, right? You basically pay people to do nothing for a while, right? So
right.
every time they went into a new market, they lost money at first.
Yes.
Okay. And then once the market got established, they didn't have to pay people for nothing anymore, so their losses would decline. But what also happened in every single market, well, in many markets, they had a very fierce competition, and that fierce competition was there because the venture capital markets was flooded with cash.
Yes.
They were basically, there was a lot of funny money, basically competing for market share.
Right.
My argument is that in August, September last year, when WeWork blew up, basically that was a wake-up moment for venture capital market. And basically, venture capitalists went to the companies and said, you need to start making money because we're not going to give you money to burn anymore. Right. Okay, so what happened? Competition gets rationalized. And now, there's one public competitor, with Uber, Lyft in the United States.
That's
and
right.
If you listen to Lyft's conference calls, That's exactly what it sounds like. The Lyft says basically, you know, we are not going to be fighting for market share anymore. We're just going to be a trend follower. So we just, if the Uber lowers the prices, we lower prices. If they
Right.
raise the prices, we'll do the same thing.
Gotcha.
So they're not trying to steal market share anymore because they realize it's a race to the bottom.
They're not building more tracks. They're just putting another train on the track.
Exactly. Yes.
Got it. Okay.
So now, Uber actually, what's interesting about this, they were gonna, before the coronavirus. In fact, this is kind of interesting. A week before we went to quarantine in the United States, the CEO was doing a presentation, and he said, "We're gonna break even. We're gonna basically cash flow positive as a company at the end of the year."
Wow.
I think that's the week later, he probably regretted the statement just because the coronavirus has changed things. But my point is, the company has, if you look at the losses, that's the old Uber. The new Uber basically now, would start breaking even, and probably in 2021, 2022 would be making a lot of money. Anyway, and then it gets more interesting because if you think about the cost structure, once the global system, marketplace is set up, the incremental cost for them of you taking a ride is almost very, very small.
Correct.
So now when you take a ride and they take 20, and you spend $10, let's say you take a $40 ride, that means they would make $10. $5 from the $10, $5 to maybe $7 from this $10 that they revenue falls to the bottom line.
Right.
So anyway, so that's kind of our, we can spend another hour talking about Uber, but this is how Uber becomes a value investment.
And on the flip side, then Tesla wouldn't fit that model because I guess it's similar in some ways where they've burned through a lot of cash up, to start with, and they're kind of around that point where they're starting to break even, but you wouldn't see it along the same lines.
Yes, but the difference is, with Uber, I could see how this will become a very profitable company that will dominate the space.
I see. Okay.
With Tesla, there are competing against a lot of other companies.
Yes. Yeah.
And I can see how, so far Tesla has not shown me that they can make money making cars.
Yeah.
Okay. They may be able to achieve this, and if they do, it's going to be a great investment. Yeah. But with Uber, I had a confidence that they both, they are the company that will dominate the space.
I see. So it's kind of like looking into the new frontier, trying to establish, right? Because we're not in the future yet, but peering into the future the best you can, understanding this new frontier. Who are they going to be the dominant players? Who will have that moat around them? Yes. And then backing those newer players versus those who have these incumbents that they're battling against, like Tesla does.
Yeah, exactly. And if you read my article, at the end I say, my God, I love the company. I love the product. I think the company has a lot of significant advantages. And I think the actual competitors have some significant disadvantages too, but it's so difficult. Like the company, when it's losing money, it's basically its health, it's tied to the kind of kindness of strangers, which is financial markets, right?
Yeah. Yes.
And so, it was very difficult for me at the time to say, this is, they will survive in this form. They may survive, but I just didn't know. So therefore, I'm gonna continue to drive the car.
Yeah,
I'm gonna love the car. I just will
enjoy what I can.
Yeah, I'm gonna observe this stock from afar. So and then I don't have to own everything. I don't have to own every single stock.
Yeah, and I guess that's the thing, right? Like every now and then you just got to sit back and you just got to cool your jets a little bit and go, well, the share market is not forcing you to play the game, right? I guess there's wisdom in just being super, super patient and not engaging too much, right? Is that kind of the philosophy that you have?
That's right, because I think knowledge is cumulative, right? So I spent hundreds of hours doing research in Tesla and came up with a couple conclusions. Number one, not to buy Tesla.
Yeah.
But another conclusion was not to buy GM and Ford either, because I'm not sure those will succeed either.
Sure.
It also helped me to crystallize my thinking about my future analysis of Uber as
Yeah.
well.
It's interesting, yeah, because like normally when you engage with something and you're fully immersed in studying it, and then you go the next step, or maybe it was initiated, I guess in your case, you bought the Tesla first, right?
Yeah.
Yep. But normally you kind of you drink the Kool-Aid. You'd be immersed so much in that view that
Mhm.
you kind of you consummate it and you buy it, right? Like you'd invest in it.
Yeah.
Whereas in this case, you spent hours and hours likely doing that paper on Tesla, and then you decided not to buy it.
Yeah.
That must have been quite a. But
Yeah.
that's kind of
No,
normal what we do, right?
no, but I learned a lot. I
Right.
learned a lot, and who knows, I might sometime down the road in my own Tesla. I mean
Yeah.
that I'm I it doesn't mean I don't own it now. I might change my mind in the future too. So it's a
Yeah.
at the time when I will get to the point where I feel I'm buying a dollar for a lot less.
Got it.
Today, I'm not even sure I'm buying. Like today, the stock is priced. Like I'm not sure what it's worth now. Number one,
Yes. Yeah.
okay, and it's a great company, but it has a market capitalization of probably the whole global car industry put together.
Yeah. No, it's insane.
So
Yeah.
is
Yeah.
it that great? Who knows? So
Yeah.
I don't
Yeah.
have to. So it's a one thing I learned about investing: when you buy something cheap enough, you don't have to be very smart. Let me explain what I
Right.
mean.
Yeah.
In
Please do.
in a like 2012, 2013, we bought Apple stock, and
Right.
the stock was absolutely hated. And my models were incredibly simple. Like literally, you could do my whole model could be done as crayon.
Right.
Okay,
Yeah.
because the stock was so cheap, I didn't have I just had to use silly numbers, kind of try to kill the growth, different things, and it still was very cheap. Over the next 5 or 7 years, as the stock went up a lot, my IQ had to go up as well. Because now I had to think, okay, well, what's going to be the average sales price of an iPhone? Okay, what's the replacement cycle? So now I had to do a lot, now I had to be a lot more precise because the
Yeah.
stock price was a lot higher.
Right.
Okay, so I kind of like, I like to solve easy problems
Yes. Gotcha.
where I can, where I don't have to have very high IQ.
Well, I like
Okay.
that concept that you don't have to have a high IQ to do this, right? Like I'm not, I know that a simple-minded person. I know that, but it gives me encouragement myself, and for the people that we're trying to reach, knowing that you don't actually have to be super smart. But what I'm hearing though is that you do have to have some sort of model or some sort of set of commandments like you do that you follow that is independent on your own perspective, which could be swayed either way depending on market sentiment or the latest fad that's out there, right?
Let me give you this analogy. So my son used to play chess. He still does, but he used to play in tournaments.
Right. Okay.
And okay, and actually the way the tournaments worked, right? He comes to a tournament and they would match him as a player,
Right.
okay, who was in about the same skill level. If he wins this player, next one he's going to play against, he's going to be a more, a higher, kind of a stronger player. And every
Yeah.
time he wins, he has to play a stronger player, right? So
Yes.
that's what happens in chess, right? Now the investing is kind of it's a little bit different. Imagine you come to the chess tournament
Yeah.
and you get to choose an opponent. You see
Yeah.
how much of kids, and there's a one that looks like a dork who probably sleeps with the chess book.
Yeah.
You don't have to play him. You probably what you want to do. You want to find a guy who probably spends most of his time in the gym, and they're like in the tournament because he lost a bet. Okay,
Right.
and, and this is what happens in investing as well, right? So I don't have to choose. I don't have to choose difficult problems. I don't have, I can actually choose the problems that I think I can solve. Okay, so I don't, when I analyze Tesla and I don't have a good answer, even though I spent hundreds of hours doing research, I say, well, okay, well it requires, it requires, uh, I just move on and do something else.
Yeah, got it. It's low hanging fruit, right? It
Yeah,
makes sense.
yeah,
It's that whatever the tree is with the juiciest fruit that you can grab the easiest, then it's not rocket science, right? Just pick the low hanging fruit.
yeah,
Makes sense.
yeah.
Yeah. Okay. So before we finish up, do you want to just give me your thoughts on if I know that like you were probably kind of intrigued by the timing of it all when the oil price kind of dropped through the floor
Mhm.
when this whole pandemic kind of broke out. And I think often about there's three things. There's oil, which I don't really know much about at all. There's gold, which I know a little bit more about, and then there's cryptocurrency. And I kind of often chew on those three topics every now and then in my head and try to find a place for it in my mind in terms of where should that be in my portfolio? What kind of macro conditions affect that? Do you have any thoughts around either oil, gold, or cryptocurrencies that you want to share with us?
Sure. So the gold, so let's start with the oil.
Yeah.
Like globally, normally, we consume about 100 million barrels a day of oil, and we produce roughly about the same amount. Like actually, the same amount, right? Today, I think our consumption probably dropped to, I don't know, 60 or 70,
Right.
million barrels a
Something like
day.
that.
Yeah.
Yeah.
So imagine we are producing, we are still, our production was still going at 100 million barrels, and we are consuming, 70, 60 or 70. So there was a huge glut of oil. I think what's going to happen is this. I think a lot of companies will, there are some weaker players will go out of business. Some wells will be shut. And it's going to be very painful for the oil industry in the short run. And when I say short run, I have no idea what short run means, like 6 months, a year, whatever. But I think what it does, it probably means we're going to have much higher oil prices down the road, because what's going to happen, like at some point, our economy will come back to normal. Okay, I don't know when it's going to happen, but let's say so our consumption will come back from 60 million barrels a day to 100 again. Okay, but our production will be destroyed. A lot of our production will be destroyed. So this mismatch between production and supply will cause much higher oil prices.
Right. In the medium to long term, that'll probably come to fruition.
Yes. Right. And this is like, it's very easy for me to talk in a kind of using this, kind of vague terms, short term, medium, because, but I don't, that's what's going to happen, I think, with oil.
Yeah. So, and I guess like I'm kind of been chewing on two different strands of this. And one of them is, well, the impact that, regulators, reserve banks around the world are engaged in quantitative easing, and in the U.S., that's on steroids right now. And the oil piece is just one of the extra reasons why they need to be doing that. But then the income level is dropping around the world in some economies that are highly dependent on oil production. And I just wonder, like, as it affects the share market, those two things, quantitative easing and the risks of even war breaking out at some stage. What do you rate the likelihood of those two events causing significant changes to markets around the world? Quantitative easing and the risk of war increasing as the oil price stays low for longer.
Well, I think if you think about the countries, there is such a concept as a Dutch disease. I don't know if you heard this. It's economists came up with it, and I think it's probably started in the Netherlands or something. But it's basically countries that basically depend on the export of one commodity. Usually, they end up being the victims of that.
Right.
And the reason this happens, because, like, let me give you Russia for a second. Okay, think about Russia, right? This is a country that had a tremendous intellectual capacity after the Cold War, broke up, right? Yeah. But the oil, but it was a big oil exporter, right? So if you're exporting oil, number one thing what happens, you start exporting oil, you start getting rubles, your currency appreciates.
Yes.
And when that happens, it means if you want to export tractors made in Russia, now your tractors are less competitive because your currency is expensive.
Gotcha.
So it hurts your other currencies. Also, what it does, the oil industry starts, or commodity industry starts attracting capital. And that capital comes at the expense of other industries. So if you wanted to start a tractor company, well, now you're competing with the oil industry as well. That's a lot more capital. So my point is this: so the countries that have benefited historically from high commodity prices, most of them are kind of mono economies. They are really tilted towards commodities, and
Yes.
so they only have plan A. There is no plan B.
Yes.
Okay? As the oil prices decline and stay at low levels, it does destabilize them, right? Just think about Russia today, right? They are losing, the whole. I forget the numbers now, but I think their budget was in a $30 or $40 oil. Now
Yeah.
oil is, I don't know, $20, whatever the number is,
Yeah.
and so they have a huge deficits now.
Yes. Yeah.
So that does not create long-term stability internally in Russia, and if Russia internally not stable, that means that instability will be exported somewhere else.
Correct.
Uh,
Yeah.
so when you look at so yes, so I would agree with you that this low oil price is actually not good for the health of kind of the of
Yeah.
geopolitics long term.
Yeah.
Um,
Yeah.
so about gold.
Yeah.
So no, no,
Big breath. A big breath
no,
there,
no,
Vitaliy.
no, no, so, no, no. So this is it's a difficult one. It's a difficult one because gold is a story. Actually, money in general, money is a story. Okay,
Yeah.
think about it. When you were a little kid, you went with your parents to a store, and you saw your parents take out, Canadian dollars at first, right? And they would buy milk, and then you would move to New Zealand, and they would have, they would
Yeah.
take out
The
New
kiwi.
Zealand dollars.
Yeah.
Kiwi, and okay. So you learned that this paper buys milk, okay, and you've seen this repeated millions of times through your life, right? And so we were conditioned that this by this, okay. So the story of paper money is a story that universally has been sold, okay. Gold is kind of a story as well, right? Because there is absolutely no reason why this shiny thing should be buying anything. Like what's like the gold bar that's sitting on your desk? What is it? Why is it worth anything?
Mm.
Like I can see it's worth something when you put it in teeth, or when you put it like I don't know, when you make
Yeah.
semiconductors,
Semiconductors, whatever.
yeah,
Yeah.
whatever, yeah. But I don't see, the properties that it doesn't oxidize are like oil. Like you can see oil.
Yeah.
There is value because it gets your car going from place A to place B, right? Okay, so it's really gold is a story, okay.
Yeah.
But it's a story that is not as widely accepted as paper money, because it's not like you've been going to your parents took you to 7-Eleven and they paid with gold coins for milk,
A
right?
couple of gold shekels instead. Yeah.
Exactly. So it's a story that's very old, which is it actually works for its advantage, but but it's not as well accepted as the paper money story. What works for gold is that the paper money can be created on the whim, and we don't even I think we just U.S. Federal Reserve just created, I don't know, a few $1 trillion worth of U.S. dollars.
Yeah.
And so is U.S. Central Bank, etc. ECB. So because you can create the money so easily, it gets debased over time.
Mm.
Okay. Which gold is finite, right? Because there is only so much of it in the ground and so much of it, above the ground.
Yep.
Yeah. So what's difficult to me about gold is that I have no idea what it's worth. But I tell you this, because like when you and I talk about Microsoft, you and I can debate about how much the company is worth, and we're probably going to be, I don't know. You say it's 130, I say 170, but who knows, right? But it's going to be.
And there'll be a formula because it'll be intrinsic value.
You can look at discount cash flows. You and I will have different assumptions, etc.
Yeah.
But you can kind of figure out what the value is. With gold, it's worth between. I have no idea. I really don't, because how much is the story worth, right?
Yeah.
So, and that's what makes it very, very difficult about gold. The reason that there is so much hesitation in my voice, because we just printed trillions of dollars worth of of money in the matter of 5 weeks.
Yeah.
So I am getting kind of warming up to gold more and more.
Yeah, there's been $1 billion of new U.S. currency created since we've been talking, I suspect.
I'm sure.
Something like that, right? Yeah,
and there was very little new gold created since you and I talked.
Yeah.
And probably a lot of mines are shut down right now anyway.
Exactly. Yeah, that's right.
So my point, I guess the point I'm trying to make is that I can see why people own gold. I can see why it may work as inflation hedge. but it should be like, I think it should have be may have a place in the portfolio, but I
Yeah.
think it should not be the portfolio. It should not
Sure.
be,
Right. A very small portion to be allocated towards that. Yeah. If anything.
Yeah, and
Got it.
cryptocurrency is, it's kind of like, I call it millennial gold kind of thing.
Yeah. Well, let's talk about that. So let's talk specifically about Bitcoin, because let's put all the other crap coins or alternative cryptocurrencies aside, but talk about Bitcoin, because that's effectively the flagship here. What are your thoughts on that?
That's I think that would be my first argument. Which one is the flag? So so that would be my first argument. Okay, so you basically assume that that's the currency. Okay, so
I'd be a Bitcoin maximalist, let's say. Yeah.
Okay, but what I'm trying to say is that's an assumption itself.
Correct.
Okay,
Yes.
so that's an assumption itself. Okay, there are a lot of advantages to cryptocurrencies versus gold, because for me to give you $1 million worth of gold, like there's a lot of metal that have to be, it's a lot of metal that I have to give you, right? And I would need to have a bodyguard.
That's right. Yes.
I can give you $1 trillion worth of Bitcoin on the same thumb drive.
That's right. Yes.
The issue is this, again, it's a story, right? And it's a story that is not as widely, it's a lot newer story. It's not as widely accepted. And people who believe in it, they're fanatics about it. But then there's a whole bunch of people that don't. So it's a story that is based on you basically have to believe that other people will believe.
Correct. Yes, that's right.
And so if you're right and you believe that other people will believe, then then it will retain its value. The problem is also, it's from a practical perspective, like for currency to be usable, more or less, it has to have some kind of stability, right? Like when a currency goes up, I think when Brexit happened, I think US pound declined on 1 or 2% in one day. It was a big news, right?
That's right. Yeah, that's right. Whereas Bitcoin, 30%.
I think Bitcoin declines 20% in one day. Let's say you want to use Bitcoin to buy a house. At what, like how many Bitcoins is that?
That's right.
So it's a very incredibly unstable, and that makes it more difficult. It detracts from its utility, so it makes it more difficult to become that. It's so really just, if you're buying Bitcoin, you just have to make sure that you're buying a story, and you have to be sure that that story is going to be told from generation to generation, and it's going to be this story basically. So that's like if you want to take a tiny portion of your portfolio, I don't know how tiny it is, but tiny.
Money, gambling money is basically what you're saying.
And then put it in Bitcoin. Why not? But but that's how I approach Bitcoin.
Yeah, no, that's good. I've never really covered sort of oil, gold, and Bitcoin in as few sentences as that in my life. So thanks for taking me through that. That was good.
Happy to help.
Yeah, that's good. So, Vitaliy, before we finish up, I just want to, and you mentioned it a couple of times at the beginning, you mentioned your the contrarianedge.com site. So what do you do on the Contrarian Edge? You're putting out a lot of articles. That's kind of like your primary place for putting out content.
Yeah,
is that right?
let me tell you a story. So in 2005, I was teaching a class at University of Denver. And at the time, I was writing articles for Financial Times. And so the Financial Times was under firewall. The articles were behind firewall. So I wanted my students to read them. So I started to create a blog, or whatever you call it. And I started to post my articles there. So almost every single article I ever written, like for the last, 15 years, is on contrarianedge.com. And but also what we did, we realized that some people don't like to read, and they like to listen.
Yes.
Especially people drive. People have long commutes. People work out, etc. So they like to listen to articles. So what we actually did, we created a website called investor.fm, like FM radio, investor.fm. And what we did, basically, you have my articles read to you by a professional narrator.
Gotcha.
And that's basically that's another place where you can listen to my article. Listen to
fantastic. Because I think, being in New Zealand, we're probably not going to be able to benefit from what you do in terms of your money management activity. But in terms of the content, that's kind of what I'm really keen to share amongst my audience here is is just another perspective, especially an overseas perspective, because that's what gives somebody a bit of depth when they're trying to grapple with issues for the first time.
Yeah. So just today we talked about the 6 commandments.
Yes.
That is the episode 1 of the podcast.
Sure. Episode 1.
About Tesla, we have 2 podcasts. It's a very long article, so it's actually the 2 podcasts on that.
Okay.
We talked about Uber, and that's literally came out today, on Tuesday today. So those would have been long reads. So you can. Your listeners and viewers can listen to them. So
fantastic. I'll put some links in the show notes to both those sources. But thank you very much, Vitaliy, for coming on the Everyday Investor. Really appreciate your time.
My pleasure. Thank you. No, thank you. So it's
fantastic. Thank you. Take care. Cheers.
Thank you.
Yeah. Cool, man. That's